5 states are silently extracting $4,000 or more in home equity from senior homeowners every single year. And the overwhelming majority of those homeowners have absolutely no idea it is happening until a bill shows up in their mailbox or they discover the deed to their home has changed hands. This is not a standard property tax. It is something else entirely. It is a quiet and systematic transfer of equity that has been operating for decades in several of these states. And a Supreme Court decision handed down in 2023 only addressed part of the problem. The remainder is still fully active today in every county across these 5 states. And in 2 of them, the situation is about to deteriorate further. Here at Social Security Simplified, we believe you deserve to know exactly what is happening to the equity you spent a lifetime building. You worked 30 or 40 years to pay off your house. Your name is on the deed.
The mortgage is paid in full. Every reasonable assumption tells you that the equity inside that home belongs to you, but the rule that actually determines whether that equity remains yours is not written into any federal statute. It is written county by county inside obscure state tax laws that were drafted before most of the people watching this video were even born. And in the 5 states I am about to walk you through, those laws still permit the government, or a private investor operating through a government mechanism, to walk away with tens of thousands of dollars of equity that you spent your entire working life accumulating. There is one filing available at a county or town office for under $75 in most jurisdictions that quietly neutralizes the worst of this mechanism in 4 of the 5 states I am about to name. I will tell you exactly what that filing is before this video ends, but only after you fully understand which states still have this rule on the books and why seniors with paid-off homes are the ones carrying the greatest exposure. This rule does not go after struggling homeowners. It targets the ones with the most equity to extract, which means the seniors who did everything right are standing directly in front of the largest potential losses. Let us begin with the case that pulled the entire mechanism into public view. A 94-year-old widow named Geraldine Tyler owned a 1-bedroom condominium in Hennepin County, Minnesota. She fell behind on her property taxes. The total amount owed, including accumulated penalties and interest, came to approximately $15,000. Hennepin County seized the condominium, sold it at auction for $40,000, kept every single dollar, and returned nothing to Geraldine Tyler. No refund, no check. Not the difference between what was owed and what the property sold for. The county walked away with $25,000 of her equity she had built over decades, and classified the entire transaction as legal under Minnesota law. For years, courts in Minnesota and several other states held that this practice was entirely acceptable. The legal argument was that once a homeowner falls behind on taxes, the entire property is forfeited, not merely the unpaid tax amount. So if your home is valued at $400,000 and you owe $10,000 in back taxes, the state could seize the whole property and retain all $390,000 of equity. Geraldine Tyler took her case to court. In May of 2023, the United States Supreme Court ruled unanimously in Tyler v. Hennepin County that this practice violates the Takings Clause of the Fifth Amendment. The Constitution is clear that the government cannot take private property for public use without providing just compensation. Seizing $25,000 of equity over a $15,000 tax debt is, in straightforward terms, a taking without compensation. But here is where most people stopped reading the news coverage and missed the rest of the story. The Supreme Court did not eliminate property tax sales. It only ruled that the surplus, meaning the equity above the outstanding tax debt, must be returned to the homeowner. The seizure can still happen. The auction can still happen. The home can still be lost entirely. The only change is that the county is now required to send the former owner a check for whatever remains after the debt is satisfied. And that is precisely where the next layer of problems begins. In Minnesota and the 4 other states I am about to walk through, The rules governing how that surplus is calculated, who receives formal notification, how long a former owner has to file a claim, and what fees are deducted before any money is dispersed are still being defined. Some counties deduct administrative fees of 15 to 25% before releasing the surplus. Others require a separate court filing just to claim it. And if the senior misses the filing window, which in some jurisdictions is as narrow as 90 days, the surplus can revert to the county regardless. The federal ruling ended the most egregious version of equity extraction. It did not end equity loss altogether. A $4,000 loss to fees, missed deadlines, and procedural traps remains entirely common in tax sales across these 5 states, even after the Tyler decision. Minnesota itself amended its tax forfeiture statute in 2024 to bring the law into compliance with Tyler. Surplus funds are now held in a state account, and the former owner can submit a claim within a defined window. But the claim form is not generated automatically. The county is obligated to notify you, but that notice goes to the address on record, which, for an estate in probate or a senior who has relocated to an assisted living facility, is frequently the wrong address. The notice gets mailed. The deadline runs out. The surplus remains with the state. This is the consistent pattern across all 5 states. The federal court closed the front door. State legislators left the side door wide open. And the people walking through that side door are the ones who already understood the process, primarily investors, and almost never the senior whose equity is being held in a state account. A 2-minute phone call to your county auditor asking whether your name appears on any surplus list from a tax sale within the past 2 years addresses this completely in Minnesota. But it is exactly the kind of call that almost never gets made because almost no one knows it needs to be made. Now move from Minnesota to Nebraska, which operated one of the most aggressive equity stripping mechanisms in the country prior to Tyler. The state used a tax certificate sale system that permitted private investors to purchase a tax lien, hold it for 3 years, and then file for a tax deed, transferring complete ownership of the property to the investor. The original homeowner had the option to redeem the property during that 3-year window by repaying the back taxes plus interest at a statutory rate of 14%. A $3,000 tax debt could therefore balloon to over $4,500 before the redemption window closed. In one well-documented case from the late 2010s, a Nebraska homeowner lost a property worth nearly $200,000 over a tax debt of less than $6,000. The investor captured all of the equity. The homeowner received nothing. Following Tyler, Nebraska updated its rules to require surplus return, but the certificate sale mechanism remains fully active. Investors still purchase tax certificates and earn statutory interest. The senior homeowner still has a redemption clock running against them from the moment they fall behind on taxes. The only change is that if redemption fails and the property transfers, the investor is now required to pay the surplus to the former owner. But the calculation of that surplus is precisely where the $4,000 figure enters the picture. Nebraska statute routinely permits the county and the certificate holder to deduct what are called recoverable costs from the surplus before it is distributed. Those costs include attorney fees, title search fees, recording fees, and statutory interest accrued throughout the redemption period. In most Nebraska counties, those deductions average between $3,500 and $4,500 per case. A senior who is owed $20,000 in equity surplus may ultimately receive $16,000 or less once the deductions have cleared. That is not theft in the legal sense following the Tyler ruling, which does not prohibit reasonable administrative costs. But for a senior living on a fixed income, $4,000 of equity absorbed by procedural fees can represent the difference between a year of in-home care and placement in a state nursing facility. The practical defense in Nebraska is therefore informational rather than strictly legal. The state requires the certificate holder to deliver notices at multiple stages of the process, but those notices are composed in legal terminology that most seniors do not readily interpret. They resemble junk mail. They get discarded. The redemption window passes. The deed transfers. A licensed real estate attorney in Nebraska, at the typical hourly rate of $250 to $350, can review those notices and tell you within 15 minutes whether your property is at risk. That $50 to $90 conversation can prevent the $4,000 surplus loss, and in some cases prevent the entire equity loss if the redemption deadline has not yet expired. There is also a Nebraska-specific filing called the Homestead exemption that, for property owners over 65 with limited income, reduces the assessed value of the home, or in some county programs, defers the property tax bill entirely until the property is sold or transferred. The deferred amount becomes a lien on the property, but that lien sits behind any existing first mortgage and does not generate interest at the higher statutory tax rate. A senior struggling to keep up with property taxes can therefore apply for the deferral, avoid the certificate sale process entirely, and preserve the equity inside the home. The homestead application is filed with the county assessor at no cost in most counties and can be completed in a single visit. But very few eligible Nebraska seniors take advantage of it because almost no one tells them it exists. Adult children are unaware of it. Tax preparers are unaware of it. The county assessor knows about it, but carries no obligation to volunteer the information unprompted. So the application goes unused while certificate sales continue to proceed across the state. Now move east to New Jersey, where the structure is different, but the equity loss is even larger. New Jersey routinely carries the highest effective property tax rate in the country. The average homeowner in counties such as Bergen, Essex, and Union pays between $12,000 and $18,000 annually in property taxes on a single-family home. For a senior who paid off the mortgage 2 decades ago, that tax bill is frequently the single largest remaining expense in retirement, exceeding even healthcare costs in many cases. That is the foundation. Now consider what unfolds when a senior in one of those counties falls behind on payments. New Jersey operates what is called a tax lien sale, similar in structure to Nebraska, but with a critical difference. The interest rate on a delinquent tax lien in New Jersey can reach as high as 18% plus a 6% penalty applied to the original balance. A $5,000 property tax shortfall can therefore grow to over $6,500 within a single year and to over $10,000 within 3 years. But the more significant threat in New Jersey is something called the abandonment doctrine. Under New Jersey statute, if a municipality determines that a property has been abandoned, the lien holder can file an expedited foreclosure action that compresses the redemption window from 2 years down to as few as 45 days. The definition of abandonment is loosely applied. A senior who transitions to assisted living and allows the home to sit vacant for 90 days while the family deliberates over whether to sell can have the property declared abandoned by a code enforcement officer, causing the foreclosure timeline to accelerate dramatically. In the average New Jersey tax foreclosure involving a paid-off senior home, the surplus owed following Tyler can range between $20,000 and $50,000. But the deductions permitted under New Jersey statute include attorney fees that, in expedited foreclosure cases, commonly run between $3,000 and $4,000 per case, combined with lien interest, the statutory penalty, and the municipal administrative fee. The $4,000 equity loss in New Jersey is, in practical terms, nearly guaranteed. The defense in New Jersey is therefore preventive rather than reactive. A New Jersey statute called the Senior Freeze, formerly known as the Property Tax Reimbursement Program, is available to homeowners over 65 with household income below the annual cap. That cap is updated each year by the Division of Taxation, so verifying the current threshold before applying is essential. The The senior freeze does not eliminate the property tax obligation. It freezes the bill at the level it stood during the first year of eligibility, and the state reimburses the homeowner for any increase in subsequent years. A senior whose property tax bill climbs from $12,000 to $15,000 over 5 years, therefore receives a reimbursement check from the state for the $3,000 difference each year. The senior freeze application is filed with the New Jersey Division of Taxation at no cost, but the application must be submitted every single year without exception. Miss 1 year, and the freeze resets at the new higher baseline. A senior who qualified at $12,000 and fails to file 3 years later finds the freeze reset at a level that may be $2,000 higher. The program carries one additional structural problem. The state issues the reimbursement, not the municipality. The municipality still bills the full amount annually. The senior pays the full bill and waits for the state to issue the difference. For a senior on a fixed income who cannot advance that cash, the program is effectively inaccessible, despite technically being available. The senior continues paying the rising bill, eventually falls behind, and the lien sale process begins. A New Jersey elder law attorney charging between $300 and $450 per hour can evaluate your tax history and senior freeze eligibility in a single consultation. The cost of that consultation is typically recovered within the first year of reimbursements received. The math works almost immediately. Now move west to Illinois, which before Tyler operated one of the most aggressive equity-stripping tax sale structures in the entire country. The state used a hybrid certificate and deed sale mechanism where investors could acquire tax certificates, accrue interest at rates that reached into the high double digits annually in certain counties, and convert those certificates into full property deeds following the redemption window. Cook County, which contains Chicago and accounts for the majority of Illinois property values, was the center of activity. In a series of well-documented cases, Illinois homeowners lost properties valued between $150,000 and $400,000 over tax debts as small as $4,000. The investors captured the full property value. The homeowners received nothing. Following Tyler, Illinois rewrote its tax code to require surplus return. But homeowner advocacy organizations have characterized the rewrite as insufficient. Specifically, the Illinois statute continues to permit the certificate holder to recover collection costs, attorney fees, and statutory interest before the surplus is distributed. In Cook County, the average deduction in a post-Tyler case runs between $3,800 and $5,200. A senior owed $30,000 in surplus equity may therefore receive approximately $25,000 after deductions are applied. That is the $4,000 equity loss in concrete practice. The defensive filing in Illinois is the senior citizen's homestead exemption, available to homeowners over 65 who occupy the property as their primary residence. The exemption reduces the equalized assessed value of the home by a fixed amount that varies between Cook County and the remainder of the state. The actual tax savings depend on the local tax rate, but commonly fall between $400 and $700 annually. The more powerful filing, however, is the Senior Citizens Real Estate Tax Deferral Program. Under this program, an Illinois homeowner over 65 with household income below the annual cap can defer payment of property taxes entirely. The deferred amount becomes a lien on the property at a low statutory simple interest rate, and that lien is satisfied when the property is eventually sold or transferred. The deferred lien sits behind any existing first mortgage, but ahead of unsecured creditors. The senior, therefore, never falls behind, never enters the tax sale process, and never loses $4,000 to surplus deductions. The deferral application is typically filed with the county treasurer in the early months of the calendar year at no cost. But very few eligible Illinois seniors use it, primarily because the program receives minimal publicity, and most seniors associate deferred tax obligations with complications for their heirs. The reality is precisely the opposite. The deferred lien at a single-digit statutory rate is dramatically lower than the much higher statutory interest that accrues on a delinquent tax line. And the lien is structured to be resolved cleanly at the time of sale or inheritance with no surprise penalties attached. One additional Illinois-specific matter worth flagging involves Cook County's separate disabled veteran standard homestead exemption, which can reduce the equalized assessed value substantially for veterans carrying a service-connected disability rating above a defined threshold. The exemption is in many cases transferable to a surviving spouse, but it requires annual recertification with the county assessor. That recertification form is mailed to the address on file, which means the same address change problem encountered in Minnesota recurs here. A senior who relocates to an assisted living facility and allows the form to go unread can lose an exemption worth thousands of dollars annually. A licensed Illinois elder law or property tax attorney can assess eligibility across all three programs in a single consultation, and the cost of that consultation is typically recovered within the first year of correctly filed exemptions and deferrals. Now, move east one final time to Massachusetts, which is the most actively relevant state on this list, because the equity tax situation there is unfolding in real time right now. The state has a long-standing property tax limitation statute called Proposition 212, which restricts annual property tax increases to 2.5% plus new growth generated by new construction. For decades, this cap protected homeowners from accelerating tax assessments. But in recent years, a growing number of Massachusetts municipalities have pursued what is called an override vote, a ballot question asking local voters for permission to raise property taxes above the cap to fund a designated project, commonly a school facility, public safety infrastructure, or major repair initiative. In many Massachusetts municipal elections in recent years, override votes have received majority approval. That pattern has drawn national attention because it means that in any given override election, the outcome can result in higher property taxes for every homeowner in that municipality. For a senior on a fixed income in a town where the override passes, the annual bill can rise by $1,000 to $4,000. The equity loss here is not extraction in the Tyler sense. It is a slow and steady drain through annually rising tax bills that the senior in the numerical minority cannot prevent at the ballot. But there is a separate Massachusetts mechanism that carries greater concern. Several municipalities have begun preliminary discussions around what is informally referred to as an unrealized equity tax, a property tax surcharge applied to the appreciated value of a home above the original purchase price. The mechanism is being modeled after similar proposals circulating in other parts of the country. None have been enacted in Massachusetts as of early 2026, but the conversations are actively occurring in town meetings and legislative committees, and homeowner advocacy organizations are monitoring the developments closely. If an unrealized equity tax were adopted, even in a single Massachusetts municipality, it would establish a precedent with the potential to spread rapidly. A senior who purchased a home decades ago for $150,000 and watched it appreciate to $700,000 would owe tax on $550,000 of unrealized appreciation at even a 1% rate, amounting to $5,500 per year in cash on equity the senior has not actually converted to usable funds. The defensive filing in Massachusetts is the Senior Circuit Breaker Tax Credit, available to homeowners over 65 whose annual property tax bill exceeds a defined percentage of their annual income. The credit is subject to a cap that is updated each year and is filed with the Massachusetts Department of Revenue as part of the annual state return at no application cost. The credit is fully refundable, meaning if the senior owes no state income tax, it is issued as a direct payment check, But the more significant filing is the local property tax exemption for seniors over 65 known as Clause 41, available in the majority of Massachusetts municipalities. The amount varies by town and ranges from several hundred to several $1,000s annually, with the application filed each year with the local Board of Assessors at typically no cost. The combination of the circuit breaker credit and the Clause 41 exemption can collectively offset between $2,500 and $4,400 in property taxes per year. Now I owe you the answer to the question I raised at the beginning of this video. There is one filing available at a county or town office for under $75 in most jurisdictions that quietly neutralizes the worst of the equity stripping mechanism in 4 of the 5 states I just covered. That filing is a homestead declaration. In Massachusetts, it is the Declaration of Homestead. In Illinois, it is the Senior Citizens Homestead Exemption. In Minnesota, it is the Homestead Classification. In Nebraska, it is the Homestead Exemption. New Jersey is the only state on this list without an equivalent statutory homestead protection of comparable scope. The Homestead Declaration is a straightforward county filing that formally designates the property as your primary residence and in most states protects a defined portion of the equity from creditors and forced sale. In Massachusetts, the protection commonly extends into the hundreds of thousands of dollars. In Minnesota, it covers a meaningful portion of equity for a primary residence on a qualifying lot. The filing fee in most counties typically falls between $35 and $75. Here are 5 steps to take this week before any of these mechanisms reach your doorstep. First, determine whether your state appears on this list. If you live in Minnesota, Nebraska, New Jersey, Illinois, or Massachusetts, your exposure is at its highest. In other states, equivalent defensive filings exist under different names, and the Senior Homestead Exemption is the most common starting point. A licensed real estate attorney or your county assessor can confirm your eligibility in approximately 15 minutes. Second, file the Homestead Declaration in your county or town. For most seniors in the 4 eligible states described above, this is the single highest yield filing available, and it costs under $75 in most jurisdictions. The filing is permanent for as long as you own the property, and in most states carries through automatically to a surviving spouse. Third, request a copy of your most recent property tax assessment from the county assessor. Compare the assessed value against recent comparable sales in your immediate neighborhood. If the assessed value exceeds current market value, file an abatement application. The filing fee is typically $0, and a successful abatement commonly reduces the annual tax bill by between $400 and $1,200. Fourth, verify whether your state offers a senior tax deferral program. Illinois, Nebraska, and several additional states allow homeowners over 65 to defer property taxes entirely, with the deferred amount becoming a lien at low statutory interest that is satisfied at the time of sale or inheritance. The deferral protects the senior during retirement and protects heirs from a forced auction sale. Fifth, schedule a single consultation with a licensed elder law or real estate attorney practicing in your state. The typical fee falls between $250 and $450 per hour. That consultation can address homestead filing, tax deferral eligibility, surplus claim procedures from any prior tax sale, and the family transfer mechanisms that protect equity in the event of incapacity. One consultation commonly recovers more than its cost within the first year of correctly executed exemptions and deferrals. The underlying mechanism across all 5 states operates identically. Equity is not taken in a single dramatic transaction. It disappears in a slow drain of fees, deductions, and missed filings that accumulates over months and years. The defense is therefore a collection of small filings, each typically costing under $100, that together protect the $4,000 or more that would otherwise disappear quietly into the procedural pipeline. Here at Social Security Simplified, our commitment is to make sure you always have the information you need to protect what rightfully belongs to you before it is gone.